January 30th, 2026 won't be remembered as just another volatile trading day. It will be remembered as the day the paper precious metals market exposed itself. This wasn't a sell-off. This wasn't fear. This wasn't chaos. This was precision. Silver didn't decline. It was slammed. A historic one-day collapse of over 30%. Gold followed, down double digits. Platinum and palladium were dragged under with it. But silver took the hit meant to send a message. And what you're hearing in the mainstream financial press is missing the most important part. Because what happened that Friday doesn't make sense unless you understand who benefited and when. While retail traders were liquidated, while leveraged positions were vaporized, while headlines screamed volatility, one institution executed a trade with timing so exact it borders on impossible. J.P. Morgan Securities closed hundreds of silver short positions at the precise inflection point of the crash. Not after, not before, not near the bottom, at it. Moments later, the market reversed. Luck doesn't work like that. Let's slow this down and walk through what actually unfolded. The paper storm. Silver had been trading well above $100 an ounce. Momentum was strong. Industrial demand was accelerating. Physical supply was already tight. Then Friday arrived. The selling wasn't orderly. Support levels didn't matter. Stops detonated in sequence. Prices cascaded through the $90s, then the $80s, finally stabilizing in the low $70 range. A move so violent it erased weeks of gains in hours. And that is exactly where J.P. Morgan closed 633 short contracts. The selling pressure vanished. Price action stabilized. The rebound began immediately. That isn't opinion. That's visible in public positioning data. The volume problem. Now here's where the narrative breaks completely. On January 30th alone, COMEX silver futures volume exceeded 360,000 contracts, with options adding tens of thousands more. Each futures contract represents 5,000 ounces. Do the math. Nearly 2 billion ounces of paper silver were traded in a single session. Global annual silver mine production? Roughly 800 to 850 million ounces. That means more than 2 years of global production was exchanged, on paper, in less than a day. That is not price discovery. That is leverage dominance. Systemic timing. This didn't occur in isolation. The U.S. government was facing shutdown risk. Liquidity anxiety was rising. Then, quietly, the first U.S. bank failure of 2026 occurred. Metropolitan Capital Bank and Trust was seized by regulators due to capital weakness. Small bank? Yes. Meaningless? No. The first failure of the year always matters. Markets price signals, not size. Prediction markets had already assigned near certainty to a bank failure, and they were right. Stress was building, and right on cue. The most liquid safe haven assets were forced lower to meet margin demands. That's how financial stress always begins. The liquidation mechanism. Here's the part most investors misunderstand. In the early phase of financial strain, capital doesn't flow into safety. It flows into cash. Margin calls don't care about fundamentals. They don't care about long-term value. They demand liquidation. And gold and silver futures are among the fastest assets to sell. If you know where leverage is concentrated, if you know where stops sit, if you know which funds are vulnerable, you can manufacture a cascade. Dump paper supply. Trigger forced selling. Close shorts at the bottom. Step aside. That's not conspiracy. That's market structure. Physical reality breaks away. Now compare this to what happened outside the paper market. Shanghai spot silver closed near $120 per ounce. COMEX closed in the mid-$80s. That's a $35 to $40 premium, even after the largest one-day crash in history. In a normal sell-off, premiums collapse. Sellers panic. Inventory floods the market. That didn't happen. Premiums expanded. Dealers across the U.S. and Europe paused new orders or quoted 2 to 4 month delivery delays. Paper cleared instantly. Metal did not. Delivery tells the truth. February silver delivery notices exceeded 2,500 contracts. That's over 12 million ounces demanded in physical form. At the same time, Nearly 2 billion ounces traded electronically. Paper markets process fear. Physical markets process truth. And truth right now says supply is tight, regardless of what futures prices show. Two types of participants. This event separated the market cleanly into two groups. Long-term physical holders saw volatility, not thesis failure. Many viewed the drop as opportunity. Mine supply didn't improve. Industrial demand didn't disappear. Monetary debasement didn't reverse. Then there were leveraged traders. For anyone running margin, this move was devastating. A 30% drop with leverage is terminal. Stops didn't protect you. They accelerated the damage. This wasn't a lesson in direction. It was a lesson in structure. Technical damage is real. Let's be honest. Support levels broke. Sentiment was crushed. CME margin requirements were raised after the collapse. That forces more liquidation. If liquidity tightens further, if additional banks fail, if credit stress spreads, there could be more forced selling. The paper market can stay irrational longer than traders can stay solvent. That risk is real. But here's what didn't change. No surge in mine output. No collapse in industrial usage. No flood of physical metal. What changed was positioning. JP Morgan closed shorts. Weak hands exited. Leverage was flushed. And when paper selling exhausts itself, only one force remains: physical demand. You cannot trade fictional supply forever without consequence. January 30th was not a market correction. It was a reset, a controlled demolition of overexposure. The data shows it. The timing confirms it. The physical market validates it. Whether a second wave comes or whether reality reasserts itself immediately remains to be seen. But one thing is certain. When nearly 2 years of global silver production trades in hours, when premiums remain elevated after historic crashes, when delivery delays stretch for months, the paper system is no longer in control. This is economic narratives. Understand structure, not headlines. Volatility reveals truth.